one of the most important lessons from crypto generally, and the reason I got into crypto or back into computer security, is because the Byzantine environment keeps you honest and robust in some sense, right? That if you've got a security bug, you don't get to paper over it and apologize. You just lose all your money and go out of business, right? And the usual thing in in a lot of the mainstream world is, I deploy a security bug. 4 years later, my successor gets stuck with it. He apologizes and promises to do better, and it costs some money and they kind of move on, but no one has enough accountability to actually fix this stuff.
3, 2, 1.
Here we go.
Hello, Dean. Hello, Henrik. Hello, Siddarth. Such a pleasure to have you on the show. Today is a day where we will discuss a very important topic, stablecoins, a very hot topic in the interchain, I would say. So yeah, first of all, thank you for being here, guys.
Thank you for having us. This is great. Good to see you again.
Definitely. Happy to be on this program again.
Yep. Excited to get cracking.
Yeah, likewise. And before we really get into the details, so for example, Siddarth and Dean, you are about to launch your stablecoins. I think before we dive deeper here, there's like one topic that really grabbed the attention of everybody in this space, which was the UST/Terra Drama. So let's talk a little bit about some lessons learned from this, especially because you guys are like actively building on your stablecoin right now. So first of all, my question for you, Dean, is the very first question of today is, did the interchain rely a little bit too much on UST? Because if you looked at all the liquidity on Osmosis, all of a sudden, so much liquidity was just gone. So do you think that there was like too much dependency on just Terra?
So there are two answers to that. The interchain didn't rely on UST at all. The interchain stayed up, transactions were processed, we had reliable ongoing connections, we had multiple zones independently, continuously operating, and UST imploded over in the corner and everything else was fine. So, one of the most important lessons is the extent to which the robustness of the interchain architecture, the Cosmos SDK underneath and all of that was proven by what happened during that drama. That was, that is a serious battle testing that it survived beautifully, right? From an economic point of view, yeah, there was too much UST from my perspective, partly because they deliberately were trying to leverage, take risks with everybody's money in order to drive large scale adoption. And, that is, I don't particularly feel that that's sort of a responsible thing to do with other people's money, but it was kind of the only game in town, right? So there was a lot of people that didn't like UST because its economics are not, are not, have some ways in which it's very importantly not robust. But it was the only game in town for a lot of stuff. And so people were, holding on to it, hoping to get something else that they could start to migrate over to these other things. But it just didn't happen in time. And so I don't think, I expect that should not ever happen again in the Cosmos ecosystem, because we've got a lot of things that were already in the pipeline to replace it with more sound money and to be able to interoperate with it to, when people wanted to do speculative stuff like that. So I think that the correction has happened and it won't be an issue in the future.
Yeah,
or it better not be.
Yeah.
Yeah, I actually also remember I think it was the Columbus 5 update when UST basically came to Osmosis. And a question for you now, Henrik, because I remember these days, I think eEuro was actually on Osmosis before UST was. So how did you experience the whole drama?
I mean, we were, but you could say that we also realized that Terra was the elephant in the room, right? It's pretty tough to compete with people who can print money out of nothing like that. So, I mean, we were there first, which in the end doesn't really make a huge difference. I think I felt like a lot of people now are like saying, yeah, okay, you could always see it was unsustainable and things like that. But back then, I gotta say, people were enabling it quite a bit. I mean, there was a lot of cheering from people who are now saying, "Oh, yeah, we could always see this was not sustainable." So, I mean, yeah, I'm with Dean on this one. I really hope we learned a lot of lessons on this. So, yeah, they were welcomed with open arms, I would say, into the interchain, and now we're reaping the results.
Yeah, I think that's actually a very good point that you just mentioned, because like now we can say, oh, we always saw this coming, and then, but I mean, there were some warnings on Twitter. I mean, it didn't come out of nowhere, but still, Siddarth, do you think that this model, this burning and minting model, still has a future? So do you think basically this concept is buried now, or can you imagine that there will be another stablecoin around the corner that can work with burning Luna and minting UST, like maybe with another cryptocurrency on another blockchain?
I mean, if you kind of look at humanity and how history has gone about, I don't think humans ever learn lessons from history. So I don't know if we'll see another stable. I mean, I know there's a couple of algo stablecoins still out there following the same model. But my opinion, at least when it comes to the Cosmos ecosystem, I think generally I find that the community of Cosmos, users, apart from the builders as well, I tend to believe more advanced in the way they think than the other communities. They tend to get more involved with how products work, and they'll surely have learned a lesson or two from what went down with UST. If you kind of just, and this is something I saw, I think, from a video that Carter made from Silk. And it was quite an interesting explanation where he talks about every stablecoin essentially being a liability on the balance sheets of a bank, or like a central bank. In case of Luna, it was kind of like the Luna was the asset side of things and the UST was the liability side of things. But what happens is every time you have UST that's minted against an asset which is Luna, and that Luna is a fluctuating asset, you end up having a lot of outstanding liabilities with less assets to back it, and then that kind of fundamentally becomes where the problem originates from. So in that sense, I think algo stablecoins, a few might just stick around because they're capital efficient, but I think people will just be more aware of the risk now. Probably not get themselves too deep into it. Have their exit plan sorted before they take too much exposure.
Yeah,
Can I add something to this?
Yeah, 100%, Dean.
So there's algo and then there's bad algo, right? So in general, I am a strong fan of very conservative, strong stable coins using over collateralized kind of architecture, but in some sense, USD is an algo stablecoin, right? Backed by mortgages and long-term, contracts. And it's, one of our advisors mentioned money is a bubble that hasn't popped yet, right? It's an algo stablecoin that we all want to rely on. So it's not out of the question that there might be good algo out there that has a robust team and enough of the right integrations to make all of that happen. But the Mint&Burn one is not that. I mean, that's just bad algo.
I mean, I would say the Mint&Burn mechanism was always actually a mirage. The real mechanism in UST was like the market making capabilities that were underpinning it in marketplaces around the place, and which made it like in some way decentralized, but completely untransparent, because you never knew how much and who was actually backing UST on exchanges and things like that, and what's their level of pain, how much UST can they accept to hold on their balance sheet before they eject, right? So I think the Mint&Burn thing was, it was a mirage essentially, which is also why I thought it was a non-event when Luna's market cap passed under UST's market cap. I mean, it never really meant anything.
Right.
Sorry, Dean.
One of the most important lessons from crypto generally, and the reason I got into crypto or back into computer security, is because, the Byzantine environment keeps you, honest and robust in some sense, right? That if you've got a security bug, you don't get to paper over it and apologize. You just lose all your money and go out of business, right? And the usual thing in in a lot of the mainstream world is, I deploy a security bug. 4 years later, my successor gets stuck with it. He apologizes and promises to do better, and it costs some money and they kind of move on, but no one has enough accountability to actually fix this stuff, right? I got back in after 2017 where nope, people had a bug and they lost $30 million and they fixed it badly and they lost another $30 million. Like, okay, now my computer security expertise actually matters. Now good security architecture actually matters. Well, Luna was an exemplar of a similar thing. Economic architecture actually matters, right? And you will get punished for, you know, for building, deploying, or investing in unsound economics. And, you know, sometimes you can tell what's unsound. Sometimes it's worth doing experiments. And, you know, and so there are some experiments out there that might actually be good, or they might fall apart too. But the Byzantine environment is going to be a, you know, a serious battle testing of anything that actually gets deployed with money.
Can I ask you something? Because you just mentioned that, like, this is actually also the beauty about crypto, that it is somehow anti-fragile because mistakes are getting punished immediately. Do you think that because Terra is about to ship a new blockchain, Terra 2, do you think this has a future, or is this just a drip on the hot stone?
I'll start and then the others can add more wisdom. So there were certainly some really good projects on the Terra blockchain, right? So there's some unsound economics, and there was a lot of work to keep it all theirs and keep it all backed by Luna. And you know, the world is not a single chain world. The world is going to be a multi-chain world. And, you know, I think it's a better strategy to, you know, try to enable lots and lots of stuff to happen. But so I think there's been a big influx of them, of these good Terra projects and these teams that have some now really relevant expertise, bringing them over into you know, Juno, Osmosis, Evmos, you know, some will go on to Agoric. A lot of them are launching their own zone, so they will now, it's like, oh, I don't actually have to rely on someone else's system. And so I think there's a huge, you know, important diaspora from that. Terra 2, you know, hard to imagine from my perspective it getting legs, but as Siddarth says, you know, people will keep trying stuff, and, you know, there might be a lot of energy behind it. We'll see. But UST2 ain't gonna happen.
Yeah, fingers crossed.
Yeah, right.
I don't know about the future of Terra 2. I mean, I agree. There's a lot of really talented people who are working in the Terra Luna environment, and I hope they migrate to other places. I gotta say, I think the people behind the original Terra, they kind of maybe need a timeout for a while, which, yeah, it seems they're not taking or getting that. But we'll see. It's going to be interesting to follow, but I hope the rest of us can kind of move on to more sustainable stuff. Like, yeah, it's I think we need less of this stuff exploding. I mean, you see it penetrating into the mainstream. It's giving crypto a bad name. You see people losing savings all over the world and being told, oh, you should have done your research, stuff like this. I mean, it just makes crypto look like a bunch of criminals, essentially.
It's a Wild West, and it looks like it. We need to do better.
Yeah, we need to do better. Exactly. Yeah.
Siddarth, what are your thoughts? Yeah,
if you kind of also look at how the Terra ecosystem grew, I think one of the key things that they focused on was they had the UST, and then they said, hey, let's focus on an ecosystem now that, you know, is bringing utility to the UST and is kind of making UST the central star of the show. So there was a whole bunch of you know, good projects as well, good builders who were building in the Terra ecosystem, relying on UST, you know, kind of outsourcing that part of thinking to the UST folks and saying, hey, we're going to bring utility to the stablecoin. So I think those folks will still be around because you know, a lot of them were building projects that genuinely added value to the broader ecosystem, not just Terra alone. Whether they choose Luna 2 or where they go, you know, that kind of remains something that we kind of see over the course of time. I always kind of jokingly say the Luna community isn't called lunatics for no reason. And, you know, they have that loyalty towards the identity of what Luna was. And I think that's what's going to keep Luna 2 alive for them. But my own kind of feeling is that the genuine builders will soon start gravitate away towards other ecosystems that can offer them what they came to Terra for in the first place.
I think it's an interesting point to make that. I mean, the Terra ecosystem was largely made up of Anchor, actually. I mean, I remember actually not many weeks before the collapse, I saw someone mention how flourishing it was, how there was so much stuff going on. And I went to the ecosystem page to click through the projects because I was not up to date. It's tough to keep up to date on all these amazing ecosystems, right? And I mean, Anchor was the beast, right? It was holding, I don't know, 14 billion UST. And then the next protocol, I don't remember, Mars or Mirror, it was vastly smaller. Like those, I mean, significant TVL in it for sure, relative to a lot of projects, but compared to Anchor, it was nothing. So like you could almost say that Terra was Anchor. That's about it.
Yeah, that's a pretty harsh judgment, but you're also right. And also Anchor was actually also one of the major reasons why the downfall was so quick, because many institutions that had UST locked on Anchor immediately took their capital off the table as soon as UST depegged very slightly from the USD. So yeah, that's pretty true here. But before we dive too deep into what this means for the interchain, I think this would be like an amazing panel for whether we should add CosmWasm to the hub, or I think that would be like an amazing panel for that. So today, stablecoins. So before we really dive deeper into how your stablecoins work, let us talk a little bit about the feeling that many people have, because Henrik, you just mentioned it, like also not only from the outside, it looks weird, also people who were like fully convicted crypto people somehow say, I do not know what I should believe now. And now the question is, which stablecoins are trustworthy right now? So do you guys believe, so maybe Dean, you can pick up this question at first, do you believe that most people will run into these major well-known stablecoins like DAI, USDC, USDT, because they are the most battle-proven ones? Or will they say, okay, we leave crypto directly without any compromise?
So the answer is, I mean, I have to say, I don't know. We just have to see. The people that leave crypto directly, they'll be back. I mean, at the point where they're now part of the mainstream, that we need to create a sound, stable portion of the crypto world that actually works for mainstream use cases. And I think there's a lot to be done there, and we've got a lot of technology to everyone collectively to bring to that. There's a fair bit of flight to high quality stable tokens, and I think it's entirely reasonable. But those people kind of, it'll be easier to communicate. Here's what will make something high quality that you can come back, that you can move into Cosmos and have, faith in the currency that you're using, or in the stable token you're using, because it's a high quality implementation. And we can be clear about that difference, right? And while there might be a future algo stablecoin that actually, is robust, fully collateralized, over collateralized stable tokens, that's got a pretty good record. That's got, that's battle tested stuff. We know what to look for. How well do liquidations work? What's the over collateralization ratios, all that kind of thing. And so the people that are in a lot of that crypto, they'll be able to grok that, because it's kind of one bit. Inter is a good stable coin. It's the right architecture, and it grows. The CMST, great, right? E-money, asset backed by euro with a bank account, and it's got audits, great. These are all mechanisms where those are the models that people can rely on. And now we're all bringing that to the Cosmos ecosystem in ways that usefully interoperate and bridge across multiple chains. I think it'll be pretty compelling to bring people back. Or bring people over, rather. It's not even back, right? It's, these are all new things.
Yeah, that's actually like a question for me, like now for Siddarth. So as far as I maybe understand it now, right, is that that this over-collateralization concept is battle proven. We saw it with DAI during the Corona crash, when MakerDAO really struggled to keep DAI's peg, but it was able to do so, which was amazing to see, which was also like very amazing for DeFi, because afterward we saw the DeFi summer, because now it was battle proven. Same thing with USDC. It's over collateralized. People trust it for years now. So in a nutshell, was this UST concept like basically never battle proven? So just for people who are new into stablecoins, was it like a completely new concept that was not at all battle proven, and we just saw an experiment that failed?
So go ahead.
Yeah, I mean, I think in many senses, when you kind of look at all these DeFi protocols that have emerged across the board following their own mechanisms, at a broad level, the way I see it is everything is an economic experiment that attackers need to attack the hell out of until one of them kind of survives through it all. So in many sense, every DeFi protocol is an experiment with a hypothesis of its own that needs to be proven against several attacks. In that light, if you kind of look at, even prior to USD, there was Ion Finance, there was Basis Cash, and all these other semi-algorithmic or algorithmic stablecoins, if you will, which kind of didn't see the light of day. And the reason being, it all kind of, every time a new kind of mechanism comes into play, it's an experiment that everyone will start using, exploiters will start exploiting until someone stumbles into the critical weakness for it and kind of takes it down. So in that sense, I don't see that, you'll still see new mechanisms pop up all the time, because everyone's going to have a new hypothesis that they would like to test out, and no better way to test it out by actually making it on mainnet and then seeing how users take to it and then kind of use it.
I do think it is worth, though, in many of these, doing economic modeling and economic stress test and attacks on it before you go to production with people's money, right? Because, one of the key things, I mean, back to this, the anti-fragile stuff, the model where you mint, and so you could have explosive minting, where literally if things spiraled the wrong way, you could end up with trillions of tokens, that are governance tokens, and now so much for your governance, right? That's an issue that is intrinsic and obvious in the design, and people warned about it. But it's one of those things where, but all these bad things would have to happen, so we never need to worry about that. And the answer is no. You have to worry about all those scenarios, and some of that you get with battle. There will be scenarios that you really can't get until you're actually in market. But all the ones that you can get before you're in market ought to be well understood and well tested, and should be, you should know you're robust against, because the fantasy of, that'll never happen, and don't look there, look over here because the returns are exciting. That's just the wrong way to go about building financial instruments.
I mean, they did claim they had, 1,000 or 1,000,000 years of simulations. So
yeah,
I guess
right.
A month ago, they would have claimed that this there was indeed the case, that they had tested it, simulated.
Yeah. And now, but I mean, like, now we can talk more about battle-proven concepts, because like two concepts that are like so far pretty battle-proven, where I mentioned it, over-collateralization and asset-backed stablecoins. And now we have like 3 stablecoin projects on the panel. 2 are using over-collateralization, and the other one is using real-backed assets, real-world assets in order to back their stablecoin. So Henrik, could you maybe start to explain to us how your stablecoins beta set work? So like how do you audit your assets, etc., etc.?
Yes, definitely. I mean, we were building the sort of boring kind of stablecoin, right? Where you have some money in a bank account and you represent those on chain to say that there's value backing that stablecoin. So it's essentially it's the USDT model, which is, you could say, very battle proven, I guess. So we have
distinguish there, because one is money in a bank account, the other is commercial paper and stuff like that. Which one is e-money?
I mean, right now it's money in a bank account, and we're working on also putting money into government bonds and stuff like that. So it's important for us to be auditable and prove that the funds are there and that they're safe. So I mean, so a lot of the work we've been doing is unfortunately not technical. I mean, I'm a techie, so I've been spending way too much time talking to lawyers and and banks and stuff like that.
Amen,
so
brother.
thank you for the. Anyway, so I mean, what we do is we need to gain the trust of community and the interchain and all the other chains that we are bridging to. So what we do is we publish quarterly. We're aiming for quarterly proof of funds, which are created by Ernst & Young. So what they do is they say, yes, this is the amount of money in a bank account, and then someone can go and say at that time, and then someone can go and say, okay, that's the amount they issued at that time. Do these numbers match up? So that's what we're doing. I mean, you could say in some ways we launched last year when we were able to connect to Osmosis. We had been live on our own chain for a while, but like a stablecoin on its own chain is in itself not very interesting. So getting the chance to go on an exchange and create pairs, that has been a game changer for us, right? So we're expanding from there. But yeah, so it's the boring kind of stablecoin, you could say, with money in a bank account, fiat, and a lot of regulation and banks and lawyers and stuff.
I would love to ask one more question here because I think that's actually very, very important for people to understand. So as of now, there is no e-dollar that you provide. You offer like the e-euro, the e-Swiss franc, then the e-krona. So could you talk a little bit about why you focus on European currencies only as of now?
I mean, we are based in Europe. So when you go to knock on the door of some financial service authority, that's the regime you're getting. That's the European one. So that means it's better for us to do the European ones. You could say that demand for Danish, Swedish, and Norwegian currency on blockchain is not very big. So our focus is on the euro. People are fairly excited about the Swiss franc, though. So that's interesting. Mm-hmm. I mean, we would like, if one day we have the resources, we would like to expand to the US dollar as well, essentially, like because people really, really want the US dollar also in crypto. I mean, they're trash talking it constantly, and it's a generational Ponzi scheme, whatever. There's no backing, all the stuff that there's people spew, but they still want it. That's what they want. The euro is a slightly tougher sell. I mean, you could say that when we started some years ago, we were envisioning that down the line, the blockchain would move closer to mainstream users. So we would actually be using it for real payments, stuff like that. I would say that it seems this has not happened yet. So we wanted to see a demand for that from the euro in that direction. So, but I've got to say right now, as I stressed a few times, I think we're moving further away from the mainstream, unfortunately. Well,
you mentioned that you're talking a lot to lawyers. So what is the reason why it is so challenging to get an e-dollar like in that form that you will provide it? Because I mean, of course, it's like something completely different to basically set up a decentralized protocol and to use over-collateralization to create a USD-pegged stablecoin. So what is for you the biggest challenge to provide an e-dollar? So what are your lawyers saying?
I mean, it would be getting the regulatory clarity, essentially. We would have to get some lawyers to say that our model was legal in the jurisdiction of the US, and we would need to find banks and stuff like that. I mean, you could say it's not exploratory work as such, but it's very resource demanding. So that's what's holding it back, essentially. Dean, did you have something you wanted to?
Yeah, I was curious. You know, I can imagine it's challenging to get dollar denominated accounts in Europe, but I'm just interested in, did you look at having, you know, e-dollar accounts for European folks or European companies that want to be able to transact electronic dollars? I don't see ironically, I don't see what US regulatory, how that's relevant to you in Europe presenting a dollar-based account to you know, someone that's not in the US.
It's a good observation. I mean, you could say that as far as I understand the law, as soon as there's dollars involved, no matter where on the planet it happens, then the federal agencies, they feel that they have a hand in this, right? There was actually a while ago a Danish company that bribed some official in Kazakhstan. So there was no Americans involved at all, but they did the bribe in dollars, and that actually made it an issue with one of the many federal agencies in the US. And I mean, so that's why we want the regulatory clarity, right? Because
regulatory clarity is something all of us want. Yes.
So I mean, that's the kind of anecdote that puts me a bit on edge, right? So where I say, like, before I put my name on this, I really want someone to tell me I'm not going to jail.
Yeah, so I think this was like very interesting to know, like how challenging it is to basically achieve this regulatory certainty. But I think now it would be like very interesting to know how you, Siddarth and Dean, are designing your stablecoin at the moment. As already mentioned, you're working with over-collateralization. So first question for Siddarth. I'm new to stablecoins. What the hell is over-collateralization?
Sure. I mean, for someone who's new to stablecoins, I would say the first level of kind of looking at it is there's decentralized stablecoins and there are centralized stablecoins, if you will. So, decentralized stablecoins are basically issued permissionlessly on chain, and they're kind of censorship resistance, which means you can't have your wallet blacklisted and you can't have your funds seized from you and things of that sort. And on the centralized side of things, you have something like the USDT, USDC. Things where there's a central element involved where the issuance of the stablecoin on chain is kind of controlled. Then within the decentralized realm, there was what we saw with over-collateralized stablecoins, which is like MakerDAO's DAI. And then there's Frax, which is an example of a fractionally collateralized stablecoin. And then there was UST Luna, which was I don't know if it was collateralized at all. But that's kind of like the spectrum of collateralization that you can kind of look at on the decentralized side of things. So an over-collateralized stablecoin in the decentralized side is basically is where a stablecoin is backed by assets more in value than the value of the stablecoin that exists. So a simple example, if there's 100 DAI that exists on MakerDAO's on MakerDAO, there's at least more than 100, 150 or $200 worth of Ethereum backing or Ethereum or any such asset that backs that DAI that exists on chain. So that's kind of like the fundamental kind of 101 of stablecoins, the way I see it.
And could you guide me like through the process? So let's say I want to get your stablecoin, which will be after it launched CMST. So let's say I have some Atom around and now I want to get a stablecoin. Can you guide me a little bit through the process? What are the advantages? What are my possibilities? What can I do? How can I basically how can I act very risk off or how can I act very risk on? So could you guide me through this as well?
Sure. So the way someone mints CMST on Composite is essentially by creating an over-collateralized position. So in this example, let's talk about $200 of Atom. So someone could collateralize $200 of Atom and mint 100 CMST against it, which kind of exists as a debt. So you're essentially borrowing against the Atom that you collateralized. Now, when you collateralize $200 of Atom and borrow 100 CMST against it, you're effectively maintaining a 200% collateralization ratio. So the protocol would kind of have a defined liquidation point, which would be, for example, 150%, where if the price of Atom in external market starts declining and comes close or comes to the 150% mark, then for every price that it falls below, the protocol liquidates the collateral asset to make that debt solvent and bring it back to 150%. So the way a user would mint CMST, as I said, would be lock up $200 of Atom into a vault, borrow 100 CMST against it. The way to kind of make it safer is by having a larger collateralization for the debt that you borrow. So instead of 200, you could be locking up $300 of Atom and then borrowing just 100 CMST, which makes it like effectively a 300% collateralization. So that's the process of how someone mints the stablecoin. And then, of course, with the defined kind of liquidation thresholds that exist, anytime the value of the collateral sneaks close to the liquidation threshold, the protocol liquidates so that all the debt of CMST that exists on the protocol is solvent.
Yeah, we will talk about the security mechanisms more detailed in a minute. But now, Dean, with the concept of CMST in mind, you're also going to launch your own stablecoin, which is called IST. So could you talk a little bit about how you differ from this concept? Because what I really love about your stablecoin is that there is not only one way in order to mint IST.
Yeah. So, and I'd like to, let me add a couple of analogies for people coming at this from different things, and then I'll answer that question.
Mm-hmm.
One is we see a lot of that over collateralization when people look at taking out home loans, right? Or sorry, line of credit against your house, where my house is worth this much, so I can borrow this much cash. And it turns out in the US, much of the dollars that are actually minted are minted collateralized by assets that have value more than they're minted against. But my animation is, in order to get a stable value out of something whose value goes up and down really fast, which is a atom or house prices or whatever it is, or gold or whatever it is, you have to lock up enough more so that it never goes below how much money you borrow. That's the liquidation, right? Is it can bounce around as long as it bounces around up here. As soon as it starts getting close to how much you borrowed, I need to sell it quick before it goes below that and I'm underwater, right? So the over collateralization is all about not getting underwater where your assets are worth less than how much is borrowed. And that's the solvency requirement that we all care a lot about. And, is very hard to have assurance of in algo environments. Okay, so the key thing, Agoric platform is largely about programmability, right? Smart contracts written in hardened JavaScript to make it really easy to get lots and lots of developers out there in the world building on this stuff, many of whom are expert at various kinds of finances, expert at being able to evolve economic activity and build new applications. And those are some of the people that will help, the next generation of DeFi launch. So our over collateralized stablecoin is built in that environment, but targeted, as you say, it's IST for interstable token. It is, designed to take collateral over IBC and mint a stable token that can be brought over to Juno and Osmosis and, CMDX and what have you, to be able to participate in pools or leverage, buy NFTs, whatever it is that people want to do with this. Okay, but the mechanisms of that, controlled by the governance of our chain, enable, primarily minting using vaults, the CDP mechanism, but you can also mint it with the parity stability module. This is, lets you use a reference stable token like USDC, something that is collateral, that is directly backed by the thing that we'd like to be, reasonably parity with. So, and bring that in, mint IST against that, and have it participate in the rest of the IST ecosystem. And the key to being able to have lots of different mechanisms is debt limits, where you can do real risk analysis, real risk management, so that any particular additional mechanism, the amount of IST that you can mint using that mechanism is bounded by the risk that the reserves of the protocol can cover, right? And so, USDC, pretty good, nice stable thing. Being able to bring it over, convert to IST, pretty high reliability. As that whole pipeline gets more and more stable, that debt limit will rise. Whereas if there's a new collateral type coming into our engine, that's brand new, doesn't have history, it's very volatile, well, it's going to have a really low debt limit, right? So people can use it some, so you can launch new collateral types, you can launch new chains and get them going, but they have to, pony up reserves to provide assurance that their asset will not hurt the overall IST ecosystem. And so that means that as the DeFi environment evolves, as we get, this programmability and extensibility on our platform with, rapid development of new, safe, smart contracts, we can have new mechanisms that are still fully collateralized, still over collateralized, that are, have robust risk models around them that we can start to add in with, low debt limits and gradually grow it as we get the battle testing we all require. So this gives us, strong fully collateralization, battle testing, and the ability to innovate rapidly from the perspective of financial evolution. So, there's people that have talked about sound stable tokens that are built using perps on either side, perpetual options on either side. So if the value of the collateral goes down, the perpetual pays off and vice versa. Well, if you had a thriving market for those, then you could introduce a mechanism using that to provide direct support of a stable token. If you have thriving insurance market, we've got people working on our platform, then you could introduce that. If you had a robust NFT market with, insured prices so that particular NFTs would have a high assurance of value, or at least the rate at which they decline is such that liquidation all works, then you could introduce some debt limit to allow that as collateral, right? The fundamental thing for these over-collateralized mechanisms is, do you have a robust price associated with it, and do you have the ability to efficiently liquidate it? And if so, that's what you're relying on. That's what's critical for the CDP model, is that you've got those mechanisms, and then the market can be going all over the place. You can still have a robust and stable token that remains solvent. You mentioned the place where DAI was stressed to be able to handle, the problem there was not the model. The problem was that their liquidation process was, it wasn't rich. Didn't have a smooth liquidation process, right? So if there was a downtime, they had an outage in the liquidation process, so suddenly liquidations weren't happening. That's the biggest, that's the critical element for the CDP model. Since then, there's been a rich liquidation market for Maker, and so it's had market upturns, market downturns, totally painless, right? Totally smooth. Market go up, market go down. There's someone in there that's doing stuff, right?
Yeah, this is like, I really want to dive deeper here. So you mentioned that in 2020, when MakerDAO was stress tested, there was like an audit with liquidations. So Siddarth, maybe like, can you dive deeper here a little bit? So were there lessons learned, and how does your liquidation process work? So how can I imagine this? Because how does actually the liquidation work in general?
So one of the interesting things about what happened with MakerDAO for what they call the Black Thursday event was, as Dean described, there was a problem with the liquidations, primarily triggered by sudden fall in the price of Ethereum in the market. I think it lost like more than 50% in a matter of minutes, or something along those lines. And what that caused was mass liquidations across the protocol, where multiple CDPs on the protocol started and needed to be liquidated at the same time. And what also kind of piled onto the problem for them at the time was that the Ethereum chain was congested, and all of these, auctions for the liquidations that were supposed to take place couldn't go through because of the congestion in the network, which effectively left no competition for the auctioners that were already auctioning there. So they could bid 1 cent for millions of dollars of Ethereum that was lying in collateral and have an uncontested bid which goes through. And that was kind of the part of the reason why they saw a major collapse. If we look at what happened with UST a few weeks ago, despite everything that was going on the protocol, the chain handled it like a champ. I mean, there was tremendous volume going on to the chain, but everything was working smoothly as intended. And the mechanism, whether or not the mechanism is flawed is a separate kind of debate. But the chain did exactly what it was supposed to do at the time, and that kind of becomes the strength of building on Tenement, on building on Cosmos. And that's kind of one of the key things that we took away as well, is that if MakerDAO faced what it faced, during their Black Thursday, but it was built on Cosmos, we probably would have seen a different outcome, because we wouldn't have stumbled into the problems that they stumbled into at that time. So in that sense, that remains one kind of the key strengths that we are empowered with. But in terms of how at CMST we're doing it, again, I think Dean captured it very well, is that liquidations becomes a key part of maintaining the stability of the stablecoin, and how efficiently you're able to liquidate is ultimately what makes or breaks the protocol at that point. So in that sense, liquidation kind of also becomes a function of the liquidity of the collateral asset in the market, which means tomorrow if Atom, let's say, drops in value, and all of the CDPs that exist on Composite, which have used Atom as a collateral, need liquidation, all of that Atom, when it starts getting sold on the market, if Atom was a token of low liquidity, it would actually experience large price dip from the liquidations as well, which would kind of require more liquidations and kind of triggers a cycle of a positive feedback loop. So in that sense, it becomes important to recognize assets that have sufficient liquidity in the markets in the first place, so that you're able to kind of define what should be the liquidation ratio for that asset. So liquidity for the collateral asset becomes one key kind of metric to consider when deciding what would be the defined threshold for liquidation. And then second kind of thing that we've also done is placed a cap on how much debt can be minted against a particular collateral asset, which means how much of Atom can people bring into the protocol to mint CMST, and beyond what point do we stop allowing Atom as a collateral, so that if all of that Atom were to be liquidated at once, the market is actually able to withstand the impact of a sale of Atom of that size. So these are kind of two key mechanisms we kind of worked on as well, in terms of figuring out for each asset that we accept as collateral, what is the state of liquidity of that asset in the market, and how much of it can the market handle in an event of liquidation without kind of seeing a massive dip in the price causing a cycle of liquidations. Those are kind of the two fundamental things that we have focused on in the liquidations model. And we were also kind of focusing on doing liquidations through auctions itself, where apart from having the protocol itself, but having users as well be given an option to participate in the liquidation process. So that's kind of the three different things that we worked on for Composite.
Can I ask you something here, Dean? Because so as far as I understood Siddarth right, was that the infrastructure of the Cosmos SDK is like generally safer for such minting processes. So MakerDAO on the Cosmos SDK would be like generally safer because we wouldn't experience these liquidation outages, or is this just a misinterpretation?
So that is, I think it might be a misinterpretation. There's the performance of Cosmos, which makes a difference. From our perspective, we're an async system with contracts that can all wake up and talk to each other in response to oracles changing or timers going off, or what have you. So we can do automated liquidations on chain, and that eliminates some non-trivial off-chain risk that MakerDAO has. At this point, they've got a huge infrastructure for the off-chain liquidation auctions that are probably pretty centralized and stuff like that. I really prefer the ability to do liquidations on-chain. Or some hybrid of on-chain, off-chain, or private chains talking, or being able to liquidate to RAMM. In our case, again, extensibility, the liquidation engine, the liquidator is replaceable, upgradable. It's something that will evolve over time to do smarter and smarter strategies. I mean, right now it doesn't go and sell on the local AMM. It takes it and sells enough to not, no more than would have a certain limited impact on the price on our local AMM, and then we use arbitrage to arbit back to whatever the market is at for Agoric, Osmo, Crescent, and et cetera. But that's something that will be able to evolve easily over time without affecting the rest of the system. And so I think there's a lot of interesting performance and efficiencies in the Cosmos stack and the Cosmos ecosystem that we can use, but I don't think there's a direct economic thing other than that performance. But as Siddarth said, the performance of liquidation is significant. Is one of the primary things in performance, and the depth of liquidity are the two key things you need in order to have liquidation be smooth. So.
I see. Yeah, I think that was like very important to clarify. And also I like it that you made it so clear how crucial the liquidation process is, because for most people it more or less sounds like a danger, like as a trade-off, but actually it's like crucial so that the whole system does not collapse. So I think that's very important to mention here. Before I
gotta add to this. Sorry, I also think it's really good, like you said, that to have as much of that as on-chain as possible to make it auditable, right? Because you can see in a case where a lot of action is happening at the same time afterwards, people are going to ask questions. And then it's really nice to be able to point to which parties have participated in this and done what, and not have all the suspicion flying around that that might be a case if it's non-transparent what has been happening. So yeah, sorry.
That's a good point. You see all these auctions, but who really won? And was it actually, you know, I mean, did I get a fair shake in the auction, or was that a back end deal? I mean, part of the whole argument for bringing a lot of this kind of stuff on blockchain is so you don't get, you know, the next Enron where in the back room someone was slipping in bids or orders after the market closed and slipping in, you know, it sort of given their privileged position. Having this stuff, you know, run with the robust kind of DeFi that we all want to live with, exactly, is really valuable.
Exactly.
Yeah, and now before I have like some more questions regarding security, before we really dive deeper here, I want to ask you like one last question about I want to ask you, Dean, one last question about like IST. So it's also possible to, or it will be possible to also stake BLD, for example, and then to mint IST. So could you talk a little bit about this, and also Absolutely. About the concept? I deposit, like, let's say USDC, and then I get IST out of the smart contract. Right. So could you talk a little bit about these two ways to create IST?
Yeah, absolutely. I mean, and that's very exciting, and it remains over collateralized. So with USDC, this is the parity stability module. This is like the PEG stability module in MakerDAO, only our economists know that that's not what PEG means, and so we had to rename it. But it is bring in USDC, mint IST against it. That makes it very easy for market makers to participate in arbitrage, participate in liquidations. That makes it easy for, you know, anyone on other networks to come in and integrate with this stuff. They don't need to buy into our platform or our token at all to be able to participate in the IST ecosystem. And the goal and the focus for the interprotocol is to make it something that is valuable outside of Agoric. And the engine is run on Agoric, or some important part of it, but it's not like, you know, the case of UST where you had to buy Luna tokens to participate in the UST ecosystem. Here, no, you can bring in USDC or, you know, or hopefully other stable tokens, Henrik, as reference and get IST. The other thing, and this is useful and powerful, but it's not at all comparable to the mint and burn kind of stuff, is if you are someone who does have BLD, that's the staking token for Agoric is BLD build. If you have that and you have it staked, then you can mint a small amount of IST against the future rewards of your staked build, right? So the staked build has a reward stream, some of which will be in the form of IST being paid for the operation of the network that runs all of this IST and the rest of the DeFi that will grow on the Agoric platform. That's a reward stream that you can basically mint IST against the future income there. And there's no slashing there. And the fraction of IST, you know, the debt limit on this, it too has a debt limit, is tiny, right? What it means is that because we used IST natively on the Agoric platform as the fee currency, as the fee token, so you pay gas in IST, now anyone with stake build can get some based on their stake rewards, right? And so, and there'll be other advantages or other benefits rather of having staked build. Obviously, you participate in governance. You can, you know, all of the ability to do liquid staking, those kinds of things will all be well integrated with this. But being able to get some amount of IST means that they can participate. Now, it is, as I said, collateralized by the future earnings of the operation of this system. So it'll never be a large, you know, it'll never be a large fraction compared to the amount of build you have, but it does enable participation. And so again, and the numbers there too will be governed by the same process that looks at the collateralization ratios and interest rates and debt limits and all that sort of thing, as you know, in the overall ecosystem. And that's, for us, you know, the options for creating NFTs, for creating IST, you know, vaults, parity stability module, build boost as it's called, which is the borrow against my, or mint against my staked build. Those are all managed by an econ committee that is formed of people not just at Agoric, but outside in the larger interchain ecosystem, in order to foster it as a currency, as a token, as a stable token that works for lots of chains. It works for lots of use cases outside of Agoric. And it'll be advised by folks like the folks at Gauntlet that will run regular modeling and attack simulations and stability simulations to provide continually updated recommendations on interest rates and liquidation ratios and that sort of thing, and do the risk evaluation for new tokens that want to come online as collateral. So as people launch new chains in the Cosmoverse, they can, they've got an exchange in Osmosis and Crescent, they've got stable token that they could use their token as collateral if they want to participate in the larger economy that way.
Yeah, thank you for this very good overview, because I think that's actually what makes me very excited about Agoric, that there are like so many alternative ways to mint IST. And regarding this question, I want to hand this first part of this discussion over to Henrik. So there are many exciting ways to mint stablecoins. There are many exciting ways to basically back your stablecoins. But what is your strategy in order to gain market adoption? So for example, Terra, they were about to launch Chai, which was like an iOS app or Android app, so you were able to pay with UST in the real world. You also mentioned that you had this kind of concept in mind for euro. So what is your go-to-market strategy in real life? Because this was actually a question that got asked many times by the community.
Yeah. I mean, I got to say about Chai, it was the original use case for Terra, as I understood, where you could some kind of a bonus loyalty points you could get in Korean shops. And then at some point it turned out that they hadn't really used Terra after all. And I don't know, maybe they're using it again now. It was murky as usual. Our approach right now is to collaborate with projects, partner up, be present on AMMs, on DEXs. We hope to integrate with some lending protocols soon. We are creating a new portal for buying euro with credit cards, so that should be a new fiat on-ramp to the whole Cosmos ecosystem. Things like that. We have we have tokens allocated for building partnerships for user adoption, stuff like that. Of course, they have to be they have to be used correctly, and unless they just end up on the market immediately. We provided incentives for some osmosis pools in the beginning, which was a very good way to get an adoption. And I'm guessing these opportunities there'll be more and more of them as things move forward, because there's so much happening now in the ecosystem, right? IST and CMST. These things are also opportunities for us to collaborate with other projects. So that's what we are working on. Essentially, that's how we want to grow organically and sustainably also. I mean, it's true. I don't want to go back on bashing Luna all the time, but I mean, you could say it's a little bit tough though, because I constantly get asked, "Oh, Terra are doing this. What are you doing?" But I mean, a lot of what they did was not sustainable. You could sort of talk about how the model might not work in the long run, but the 20% in Anchor was not sustainable. So I mean, we want to grow sustainably and organically to make sure that the funds are safe with the stablecoins, right? That's so important.
Yeah, I will guide this. I will give this question over to Siddarth and to Dean now. So maybe you, Siddarth, you could start with it. So what is your go-to-market strategy as of now? And then maybe, Dean, you can pick up this question as well.
Sure. So in terms of the broader approach that we've had at the Comdex team and the Comdex ecosystem, we've kind of always focused on this CeFi DeFi bridging as a part of our long-term vision of what we want to build. So one of the key aspects that we're also focusing on in terms of long-term adoption for CMST is to bring CeFi adoption there. We already have our enterprise trading platform live, where commodities traders, institutional clients in Singapore, Hong Kong, Malaysia, and Dubai are currently using it. So we're already in the process of kind of, getting agreements with them where they would start using CMST for their internal settlements as well. And then we build out that settlement layer on that application for them to start using CMST. In fact, the interesting thing is we kind of, when we started ideating for ShipFi, which is a platform we're launching later this year, we always figured that we needed a stablecoin at the center of an application like ShipFi for it to work, and which is how, back in June last year, we kind of focused on, shifted our focus also towards creating what we originally called USTX, and which is now CMST. So we always had this idea that, for these applications like the enterprise trading and the ShipFi to kind of work in tandem, we needed a central stablecoin that kind of works in both of these ecosystems. So on the CFI side of things, that's where we kind of look at a lot of the CFI adoption coming from. We're also actively looking to partner with, various on-ramp, off-ramp providers. We recently partnered with Cardo from the Terra ecosystem as well. So they'd be helping us with an on-ramp, off-ramp service for retail clients to start using CMST. And then within the DeFi realm of things, all the Terra bashing aside, if you look at one of the kind of things that Terra did in terms of doing well, I guess, was that they not only created the stablecoin, but also, incentivized creation of a whole ecosystem around it, which was what kind of drove adoption for UST. I mean, Anchor definitely was majority of the adoption that they got, but I think the underlying message was that when you create adoption, when you create utility for the stablecoin is when you get the adoption. So in that sense, under the hood, we've always been building out our kind of DeFi ecosystem products that we wanted to bring to Cosmos. So we have our own, lending borrowing application called Komodo, which we're also pretty much in the final development stages of right now. So we're looking at kind of having Komodo coming live very soon after, or almost simultaneously with CMST. So that would allow people to kind of mint CMST on day one and start earning yield by lending it out on lending pools on Komodo. With the synthetics application as well, C-Asset, we've received quite a good amount of feedback from the community on various aspects of it, and we got to test a lot of it, a lot of testing on the DevNet ourselves as well, which we're now kind of working on in the back end again to tweak. So as soon as C-Asset is closer to coming live, we'll accept CMST as collateral there to mint synthetic assets, and probably create liquidity pools with CMST for synthetic assets there as well, which would again bring greater utility to CMST on day one. And then as soon as you kind of have CSwap, which is the DEX where we'll have the trading of all these synthetic assets, we'll also have liquidity pools there with CMST, with other assets, other IBC assets as well, like CMDX and assets from the overall broader ecosystem. So focus would be to create various avenues to earn yield on the minted CMST on kind of day one. And the way we're doing it is focusing on the CSwap DEX and Komodo lending borrowing application. And then ShipFi, as and when it kind of, as we come closer to it and closer to Q4 this year is what we're, optimistically looking at. We kind of want to work with the ShipFi team in a partnership where, if you guys are familiar with how MakerDAO is partnered with Centrifuge, we're looking at a similar kind of partnership there where ShipFi becomes the hub that creates these real world asset tokens on chain. And then we can kind of collateralize those assets to create CMST on chain, which then go towards funding those assets in the real world. So that's another kind of structure that we've worked on and working closely on with our legal team and the ShipFi team right now to work on. But these are kind of, I would say, the three major approaches we have towards go-to-market for CMST.
I would just give this question now to Dean. So thank you, Siddarth, for this overview. But I'm curious, what's IST go-to-market strategy?
So there's IST to go to market, and there's Agoric go to market. Agoric is of course a platform that's really focused on enabling third parties to build smart contracts and build a rich ecosystem and economy in JavaScript initially, and then maybe WASM in the future. But that's the thing that IST was intended as the grease of that economy. Since then, the desire and demand for it as a interchain stable token that can be used across a broad number of zones across the interchain, has just burgeoned even before this UST thing, right? So people are really excited about it, even starting back Cosmoverse and so forth. And so, the so, we're embracing that as Agoric's first go-to-market to make it available for the use cases that other people have on the interchain. So the things you want to do on Juno, the things you want to do on Evmos, the things you want to do on Osmosis, providing a stable token that they can use their capital assets against in order to enable that, it has been the focus, where what we bring is the programmability to have this be able to evolve and grow and have ever better collateralization, capital efficiency, while still maintaining the robustness that you want out of a stable token. The strategy, the process Siddarth was talking about of build up a suite of applications. We considered that, and that's, obviously quite a valuable thing to do, but our focus really is on enabling other developers to build that. So I would be delighted, Siddarth, if you do your thing, but then eventually you build some of it on Agoric and bridge the two across so that it's part of our, our extended interchain ecosystem, is all of these things interoperating well, right? The programmability, so the big, Agoric is really focused on being a bridge to mainstream, where the place you got to start is mainstream developers. And so that's the whole reason for the enormous amount of work it's taken to get, so we can use, deterministic hardened JavaScript as a programming model, and we can use it to extend IST and grow it in a way that means that we can start to get mainstream developers building use cases. And we had at the Gateway Conference in Prague, we had some developers on our platform, one doing a lending platform, one doing a NFT platform, where they gave the presentations about how to build using the Agoric model and how to build in this environment to, a bunch of interested developers out there. And so, once that engine gets going, where we can start to recruit a whole new class of developers that haven't been in crypto before, I think that ball will get rolling really quickly. But in the meantime, there's just an enormous amount of value to make this stuff accessible, available, and generously integrated with the other chains in the Cosmos ecosystem to really enable that to be part of this extended economy that will reach out into these new mainstream use cases. And, as I said, ShipFi and people that are working on mainstream use cases now, that's just critical. I mean, those are all going to be really
I agree with this whole ecosystem. Our philosophy, we were like, okay, we will issue this trustworthy, transparent stablecoin, and then take advantage of this products. I mean, we will not be launching our own lending account. What we have what we've chosen to focus on here. So yes. Leverage the ecosystem, I think, is very important. I mean,
right. The fact that we can bring, that you can do that, and then we can bring it over to our ecosystem as we roll out smart contracts and have it incorporated in there, bring it as one of these high quality collaterals, that sort of stuff. I'm just really excited about e-money, because they solve a problem that's hard, and they solve a problem that all of us need, and they solve a problem that, I'm not positioned. There's just no chance my company could possibly solve this, right? Separation of concerns and comparative advantage is what economies are all about. And this is a really good example. Us three are a really good example of relying on that, and IBC is a big part of what made that possible.
Yeah, exactly. I mean, the whole IBC philosophy, I would say, is essential to also us picking the Cosmos SDK in the beginning. Just this idea of interoperable zones and applications is very powerful.
Yeah, I think how you basically just said this is like wonderful. And I think that's also the beauty of Cosmos, more or less. Also that IST's strategy also relies a lot on interoperability, which is like what Cosmos is definitely all about, interoperability and a multi-chain future, 100%. To wrap things a little bit up, I want to discuss, last but not least, some risk that people have to keep in mind. So one question for you, Henrik, and then maybe Dean and Siddarth, you can talk a little bit about the risks when using your stablecoin. So one risk of using e-money would generally be that if we would experience a bank run on your real life bank where you deposited the money in order to back your stablecoin, like this would be like the biggest risk, right? For people who hold your stablecoin, or like if Ernst and Young would betray with the numbers or with the auditing. So these are like just these two risks
would
that
never
people
do
like
that.
have to keep in mind.
I say to a German, no.
Yeah.
No, sorry.
Wirecard.
Yeah, don't mention the war. Yeah, that's true. I mean, but that's, I mean, all the models, algo, collateralized stablecoins, they have drawbacks and have advantages. Like the drawbacks for us is like it's a centralized project, really, right? You have some banks, you have some. So what a lot of our work goes towards mitigating those risks. So that's the reason we want to put money into bonds, because in case the bank collapses somehow, the banks collapse, they reduce the counterparty risk, of course. It's also the reason, like, why obviously we have the audits. It's also the reason the team is like completely doxed, right? I mean, we're not exactly pseudonymous. Yeah, that's like we are well aware of those drawbacks of centralized stablecoins and are working to alleviate any concerns people might have about it. So that's the way we approach this.
So yeah, Dean, like maybe you can pick up this question. So what are the risks when holding your stablecoin IST or like Siddarth CMST?
Right. So you know, it's around debt limits and liquidation. You know, there's counterparty risk of there's a collateral and its value goes suddenly to zero because of some horrible bug or whatever, or you've bridged it across a bridge and the bridge goes away. So there's risks that have to be built into the collateralization ratio and the debt limits. You know, the key thing is, how do you maintain solvency of the currency? And with over collateralized, it's if you can liquidate, you know, remember I said here's the stable line and here's the volatile line. If it starts falling, if you can liquidate before it falls below the amount you borrowed, then you're good, right? I mean, it's fine that happened, and you know, then the price keeps falling, and things that were more over collaterals, they get close to the line and they get sold off. As long as you can keep that funnel going out to the people that want to buy it at the new lower price, you're good, right? Now, you know, in some sense, you can see of this loan to make sure that it is fully collateralized by having higher collateralization ratios. So as it bounces here and starts to go down, you have plenty of time to sell. And you can also protect it with a reserve. And so we do both, right? And the bigger the because you're absorbing that risk in the reserve, and you know, and economists and modeling and agent-based simulation and all of those provide you good information about what levels you need for collateralization in that reserve in order to protect the solvency of the chain. A bank run, you know, first off, it only is really significant if a significant amount of collateral is tied up in the stable token. From our perspective, where mostly we expect to see capital assets from other chains being used for this collateral, there we would not typically expect there to be a significant portion of that, right? You're not going to see 60% of atoms being used as collateral to borrow run. You're going to see smaller percentages of that because big chunks of it are being used in stable tokens, or sorry, being used in staking. And at the point where you get liquid staking mechanisms, what have you, those may come over and be used as collateral, but again, they don't put, you know, there's lots of other use for those as well. And so unlike systems where, we're entirely relying on our chain's asset type as collateral, once you're spread across multiple IBC assets, the run on the bank scenario, okay, maybe this week Juno is falling, but it's not going to go, you know, drop to zero, or it's falling, but Evmos is fine and Osmo is fine, and, you know, and Atom is fine. You know, you have to liquidate that smoothly, efficiently to make sure your chain remains solvent. But the run on the bank scenario, we have to model, but that's covered by plenty of time to liquidate on the way down, and then reserves if we end up having to liquidate under market.
Siddarth, your concept is also working very similar. For me, it also sounds like that your concept also helps to strengthen the tokenomics of many IBC assets, like we see it with DAI and ETH on MakerDAO nowadays.
Yep. And I think Dean again captured very well, what risks holders of such stablecoins should be aware of and how they can kind of protect themselves against it. I kind of realized there was one more key aspect I wanted to touch upon, which I'll just quickly do right now. So, inspired by MakerDAO's peg stability module, how at IST it's the parity. Correct me if I'm wrong, Dean. It's parity stability module, if I'm not wrong.
Yes.
Yeah, and at Composite we're calling it the stable mint module. Is essentially allowing users to use bridged USDC, bridged DAI, bridged USDT. So one of the kind of key benefits that this also brings right now is even though these assets that people are able to bridge from other ecosystems to Cosmos, once they're bridged, Axelar is not fungible with USDC that's brought to Cosmos from Evmos or Gravity when it enters the Cosmos ecosystem. So one of the key things that the stable mint module would do is allow users to bring all their liquidity from various bridges to the Cosmos ecosystem, pointed to the stability mint module. The stable mint module, where they're able to kind of mint IST or CMST against it. And at that point, all that liquidity kind of gets focused or channeled towards in the Cosmos ecosystem. So this would again kind of help solve the broader problem of fragmented liquidity in the ecosystem as a whole. And in terms of the broader kind of long-term plans for CMST for us is obviously to integrate with applications like ShipFi and builders who are kind of doing real-world integrations on chain, is to bring real-world assets on chain and then have them act as collateral. Even there, we're kind of working on mechanisms how those assets kind of remain protected. So in the case of ShipFi and commodity assets from the real world, we're kind of only looking at insured commodity cargoes, so that even in cases of defaults, the insurance covers up to 80 to 85% of the value of the shipment, and that kind of effectively becomes a collateral that back the CMST that is meant to finance that debt in the real world as well. So on the real world side, we have teams that are kind of working on various mechanisms within the existing realms of TradFi and what TradFi has to offer there. But of course, on the DeFi side of things, there will be an ongoing effort from the team to kind of understand and study the liquidity conditions of all collateral assets in the market, and then have various ways where people are always or the users are always informed what safe practices are in terms of holding and minting the stablecoin.
I really like how you're approaching real world use cases for crypto. I think that's the way we should all be working on heading. Exactly. I mean, otherwise the crypto community is just closing in on itself and just inventing new ways to leverage the same capital, which seems
Absolutely.
to be. So I really admire that you're working towards that.
Very well said, Henrik. And I think this interview is getting longer, so I want to wrap things a little bit up to give an overview. So you mentioned it, Henrik, everything has its advantages and disadvantages. So there are like certain levels of risk. But what I really want to highlight here is that what I really learned today is that Terra was actually like a huge experiment still, and that you guys have a way more battle-proven concept that you will bring to the market or already brought to the market. So I think this is very interesting here to say as well. And all your market strategies really rely on this concept of interoperability and a multi-chain future, which is ideal for the Cosmos ecosystem. And this is also what the Cosmos ecosystem is all about. So very like this idea as well. And yeah, I think there's a lot to unpack in. I think we could talk about this topic for hours and hours and hours, but sadly our time is somewhat limited. With that being said, thank you, Dean. Thank you, Siddarth. Thank you, Henrik. And I hope I see you soon on the show.
Thank you so much for having us.
It was a pleasure.
Thank you.
Bye.